Leslie, what about that point that Gary Cohn made, or I think it was Cohn,
Yes.
on moral hazard of the idea that you won't buy a bank unless it's first in receivership?
I thought that was a really critical point, and it just goes to show exactly how we will be looking at these situations moving forward, because it's clear, and you can see it in the stock price reaction. All of the Wall Street analyst coverage from today, J.P. Morgan got a good deal here. This was a good situation for J.P. Morgan to be the winner of these assets, of these liabilities. And so he brings up a good point. You know, what is to have a private capital market solution ahead of time when you can get it out of receivership? You can go above your deposit cap threshold as a result of that. And, you know, from a financial standpoint, J.P. Morgan is looking at an accretive deal.
Is the $250,000 FDIC coverage basically a moot point now? Does anybody care about it?
They do care about it, and to the extent that...
How can you say that?
Well,
I mean,
there will be smaller banks.
They were rescuing the banks, weren't they, in part, that put $6 billion, $5 billion, $6 billion in a month ago?
Yeah, no, I think it's a great point regarding these specific situations, which grew at a really rapid pace. They had a specific concentrated group of customers. Oftentimes they were startups in the case of Silicon Valley Bank. In this case, it was high net worth individuals. They had a large concentration of their deposit base that was above that threshold. Now, there are discussions with the FDIC. There was actually some news out just a short while ago about their decision or several options that they're floating with regard to reforming that level of insurance. But historically, that is what matters. And there are smaller banks that fail all the time that do have to abide by that.
All right, Steve, let's turn to the Fed, which is meeting starting tomorrow, and the results will come out on Wednesday. Do these bank wobbles matter to the Fed and what they do on interest rates, as opposed to what they do with regulation? Mr. Barr's report on Friday.
I think there's two ways that it matters. I'm wondering now if maybe they wanted this thing resolved before the Wednesday meeting, as well as wanting it resolved
the timing,
by Sunday. I mean, look, obviously they try to get these things done on the weekend, but I think it matters to the extent that there's potential systemic risk from this, and I think they look at this and they see something of a green light to raise rates because it doesn't feel like this is wider. There obviously may be other banks, but if they can be handled in such a way, which, by the way, is my one concern with J.P. Morgan. I have a different one with everybody else, which is J.P. Morgan, they sometimes said Papa Jamie, whatever it was, or Uncle Jamie, whatever you want to call it. Is this where we want to use Jamie? Is this the bank we want him to come out now?
Bazooka?
I had a discussion with Les. Is this right? If you're trying to sort of finesse the king in a game of bridge, you don't play the ace until you've seen the king. And if Jamie's the ace in this case, I'm not sure we wanted to play the ace here. But maybe that's okay if that's one. And the other one, though, is that the Fed's going to consider is this longer-term risk or effect of tighter lending standards. And that's going to be something that the Fed needs to weigh. It's probably a reason to pause. And I can give you a little heads up on our CNBC Fed survey tomorrow. A lot of folks, everybody thinks the Fed's going to hike, but a lot of folks think the Fed shouldn't hike because of concerns over banks.
Mike, just jump in here because the market reaction is also telling. And what does it tell you?
Well, the market is still behaving as if the stress in regional banks is beyond that phase where we have to worry about day-to-day liquidity issues and a real stampede of deposits away. And it's more about earnings power is going to be impaired over there, but it seems to be somewhat segregated from the rest of the market. Today, you have consumer cyclicals and you have industrials that are generally up on the day, even with the regional banks giving up another 2% and trading very close to their lows. And then as it really gets integrated into the Fed outlook, the way the equity market seems to be approaching it is the SVB crisis, or the crisis that was touched off in early March, sort of gave us back 25 to 50 basis points of hikes that we might otherwise have expected. That could be wrong in the end, but right now that's the premise. And the question is, at what cost? And if we don't know the cost in terms of credit contraction. We know that Jay Powell conceded in the last press conference that they considered pausing and that there is going to be some effect, contractionary effect of these credit issues, but we just don't know what. Meanwhile, economic numbers coming in a little better than expected. It seems like activity levels have been warmer than feared. And so today, even when you got the better economic data, better than expected, not necessarily great, you see yields drift up a little bit. You see us brace for can we pause or not? And so I think that's going to be the push-pull that we're in for a little while. But right now, I don't think that the market feels as if this is going to be, okay, who's next? That game that we remember from 15 years ago.
Good, and John, jump in here. One of the topics that we've got our eye on is how concentrated the stock market's performance has been in a handful of stocks, 5 to 10 of them. How do you look at that particular sort of state of affairs?
Thanks, Tyler. I mean, it's fascinating. Looking at the market, you wouldn't even know that there's a banking crisis going on, that First Republic had just gone under. I think a lot of investors did breathe a sigh of relief with some of the tech earnings that we saw last week, and that helped drive the market higher. And I almost wonder if Apple's earnings later this week are going to be more consequential for the market than this bank failure, than some of these other things going on at the regional banks.